In this video, we're going to talk about option spreads for beginners. So it's going to be very much an introduction to what an option spread is. And we're going to review sort of the most common ones. And then we're going to jump over to a whiteboard and we're going to run through an example where we compare just buying stock outright, buying a straight up call option, and then buying a option with a spread. So my name is Tyler Stokes from StokesTrades.com. I'm on a journey to become a full-time day trader, and I am studying options right now. So if you're looking into option spreads, I would recommend that you have a good, foundational sort of understanding of what options are, selling options, option prices. So what, factors into an options price, and then even some of the option Greeks. And we've kind of done videos on all of those topics. So you can find links to those below this video. And if you're interested in becoming a day trader, then you can consider downloading my 6-month blueprint. And that outlines everything that I'm doing over the first 6 months of my journey of becoming a full-time day trader. And again, we are wrapping up our section on options. So let's jump right into it. And we're going to talk about option spreads for beginners. So again, this is going to be an introduction to what option spreads are. And we're going to try not to talk too much about strategy. So for me, when I'm studying this stuff, if I also layer in this idea of, when you would maybe want to use a particular option strategy, then I kind of get confused a little bit. So for me, I like to just step back and just firstly understand exactly what is an option spread, what are the different types, and then later we can talk more about when you would maybe want to use a particular spread. So here we just want to kind of talk about the definitions and what they are, and then we'll run through an example. So okay, what is an option spread? So basically an option spread, it involves buying and selling an equal number of options contracts on the same stock. So this can be either call options or put options, but not a mix of both. And the options must differ in strike prices and or expiration date. So what happens is with an option spread, you buy a call option, for example, and then simultaneously you sell a call option. And then what would differ would be the strike prices would either differ or the expiration dates on the contracts would differ, or you would have a combination of both. So that's basically what it is. You're always going to use the same stock, the same underlying asset is going to be the same with an option spread, and the amount of contracts are going to be the same. So if you buy one contract, you're also going to just sell one, or if you buy 5 contracts, you're also going to sell 5. It's going to be on the same underlying stock, and then it's either going to be calls and it's going to be put. So a spread will not have a call and a put. A spread is going to have either a buying a call and selling a call, or buying a put and selling a put. So that's basically what these option spreads are. And there are sort of 3 categories for them. And the first one, which seems to be the most popular and which will be the one where we do an example later on, it's called a vertical spread. So basically these involve buying and selling options, and then the strike prices are going to be different. So if we just run through a simple example here, and we're looking at Tesla as the underlying stock, a vertical spread for a call option would be you buy a Tesla call option that has a strike price of $150 and it expires in 1 month. And then at the same time, you buy a Tesla call option with a strike price of $160 that expires on the same day in 1 month. So that is what a vertical spread is. You're buying a call option with a strike price and you're selling a call option with a different strike price. And for put options, it would be the exact same thing. You buy a put option with a strike price of say $150 that expires in 30 days. And then at the same time, you sell a put option with perhaps a strike price of $140. So that differs, but it would expire in 1 month, 30 days. So that is what a vertical spread is. Very simple to understand. And then we have what's called a horizontal spread, and it's also referred to as a calendar spread. So what happens here is the strike prices are the same, but the expiration dates on the options contracts differ. So again, if we're just talking Tesla stock here, you might want to build one of these by buying a call option with a strike price of, say, $155 that expires in 6 months. And at the same time, you sell a call option with the same strike price, 155, but the expiration date would be 1 month. So that is a horizontal spread or a calendar spread. And then lastly, we have a diagonal spread. And basically, this, you're just combining different strike prices and different expiration dates. So, for example, here you might buy a call option on Tesla with a strike price of 160 that expires in 6 months, and then you sell a call option at the same time with a strike price of 165 that expires in 1 month. So again, the strike prices are different and the expiration dates are different. So that is what these main spreads are. And it's important to remember that when you're buying and selling these spreads, you are going to use the same stock, the same amount. So if you buy one call option, you sell one call option, and then exactly what differs is the strike prices will differ. That's a vertical spread. If the expiration dates differ, that's a horizontal or a calendar spread. And then if the strike and the expiration dates change, that's a diagonal spread. And that's really what those are. So now when we move on to discuss them in a little bit more detail, we also have these things called a credit and a debit spread. So when I was personally looking into learning about this, I was kind of getting tripped up a little bit with this whole notion of credits and debits. So the finance background that I sort of have back in university, I studied accounting. And if you're familiar with accounting, debits are all seen as sort of positive entries in an accounting ledger. But in terms of investing and with options trading, a debit is actually money outflow. So a debit spread, sort of in the context of trading, it's when you initiate this, you are paying out more money than you are receiving. That's a debit spread. You're paying out more. So the result is a net debit from your trading account, meaning your account balance decreases by the amount of the debit. And then a credit spread, on the other hand, it's when you receive money, more money than you're paying out. So this results in a net credit to your trading account, meaning your account balance increases by the amount of the credit. So again, in options trading, a credit means you're receiving money, and in options trading, a debit means you are spending money. Now, the accounting context is a little bit different, and that's where I sort of my brain goes to. A debit is an entry that either increases an asset or an expense account, or decreases a liability or an equity account. And then a credit is an entry that decreases an asset with accounting. So there is a little bit of confusion there. If hopefully this doesn't confuse you even more. But if you were sort of wondering that as well, then that's sort of what the difference is. There's a little bit of confusion that arises, again, because in accounting, a debit to a cash account means an increase in cash, while a credit to a cash account means a decrease in cash. But in trading, again, it's the other way around. A debit to your trading account balance, that's like paying for a debit spread. It decreases your cash, and then credit is money in. So when we look at these in terms of these option spreads, what we have are credit and debit spreads. So in a credit spread, basically what happens here is you sell an option that generates more premium than the cost of the option that you buy. And then a debit spread would be the other way around. So for just examples here, for a call option, you would sell a call option with a lower strike price and buy a call option with a higher strike price. And what that's going to do is the one that you sold is going to be worth more. So you're going to basically have a credit. You'll have money coming in when you initiate that spread. And then for debit spreads, a debit in options trading, like we just talked about, that's money going out, or a net cost. So when you set up one of these for a call option, for example, you're going to buy the call option with the lower strike price. That's more valuable. And then at the same time, with a vertical spread, you're selling a call option with a higher strike price, and that is less valuable. So you have a debit to your account. You've got an outlay of money. So that's a debit spread. And then a credit spread is when you are receiving more for the option that you sell. So a little bit, hopefully you didn't get confused even more with my sort of explanation there in regards to credits and debits, but that's the best way that I was able to kind of come around and clearly sort of understand those different spreads, debit and credit spreads. Now, unfortunately, there are sort of other names for some of these popular vertical spreads. And I'm going to sort of just go over them here, but below this video, you can find a link to this article where you can reference these and sort of review them for yourself. Reviewing them once, you might not remember them all, or you might be able to sort of, review them later on and then memorize them or just figure out a way for you to remember them. But, there's just different ways and terminologies that sort of mean the same thing. So the first one is a bull call spread, and that's the same as a call debit spread. So what we talked about, where you'd be selling, where you'd be buying a call option that is more expensive than the one you sold, that's a call debit spread. It's also referred to as a bull call spread or a long call spread. So, if you're bullish and you're long, those sort of mean the same things. And then call, in this regard, we're talking call options. And then obviously spread is we're setting up a vertical spread. So those all mean the same things. A bull put spread, that's the same thing as a short put spread. So shorting when you're selling, and a put credit spread. So basically with a credit spread, what you're selling in regards to your put options, you're going to be receiving more than the put option that you simultaneously sell. And then bear call spread is the same thing as a short call spread or a call credit spread. And again, when you think of that credit, that's the easiest way for me to think of it, is the call option that you are selling is actually going to be more valuable. So it's not a sort of a bullish view. You don't think the stock is really going to go up that much because you wouldn't sell the call option at the better strike price. If you thought that the stock would go up, you'd be buying a debit a call debit spread. So again, you just sort of need to probably go through this article and just reread these a few times for you to fully understand it. And then bear put spread, again, that's the same as a long put spread or a put debit spread. So again, with a put option, if you have a bearish outlook, then you're probably going to buy the put option that is more valuable than the one that you sold, because you do think that the stock is going to go down. So you just need to, have a good grasp of what call options are, what put options are, the pricing, and if you kind of reviewed all the videos that we've already done on this channel, again, they will be below, then kind of going through this shouldn't be that difficult if you're not sort of seeing these things for the very first time. So again, just some terminology there, just to be aware of that all these names sort of mean the same thing. And if you sort of just dissect them and think about them and have a little bit of background knowledge about options, then it shouldn't be too difficult to understand. So those are the main spreads there. So what I thought we'd do now is actually run through an example of a vertical spread on the whiteboard, and then we'll talk about what it looks like to run through these three different options where we just buy a stock and see what the outcome is, where we just buy a straight up call option, and then where we set up a vertical spread, and then we'll see through three different scenarios what our outcome is when we kind of run through this example, so we can kind of see potentially the benefits of setting up these vertical spreads when you are actually doing trading and investing. So let's jump over to the whiteboard, and then we'll summarize what we've done on the whiteboard after we do it. Okay, so let's do that now. Let's jump over. Okay, so let's go over three different options and then three different scenarios on the whiteboard here, so you can sort of see an option spread sort of in action and how it compares to straight up buying a stock or just buying a call option. So for these examples, let's just pretend we're talking about Tesla stock, and let's pretend that Tesla stock is currently trading for $150. So our first option is going to be just purchasing 100 shares of Tesla at $150 per share. So that's going to cost us $15,000. So right away, this option, you can see that there's quite a bit of capital outlay to control 100 shares when you're just buying the stock. You need to pay $15,000 for that. So your potential risk theoretically is the full $15,000 if Tesla stock goes to zero. Theoretically that might happen, but in reality it won't. But again, on the flip side, theoretically, you're unlimited in terms of your potential profit. It could go up to infinity, but in reality, it won't do that. But, just know that for each sort of dollar increase in the stock price, your investment would go up by $100. That's an easy way to kind of look at it. If Tesla goes to 151, you own 100 shares, you're up $100 on that position. So that's option one, just, buying the stock straight up. And then option two, in our example here, is going to be just buying a call option. So again, Tesla stock is trading at 150 for this example, and let's pretend we buy a call option with a strike price of 150. So again, that gives us the right, but not the obligation, to buy Tesla at $150, and it's going to expire in 1 month. So there's 30 days to expiration. And let's assume that this is going to cost us, so to own this contract, to have the right to buy at 150, it's going to cost us $10 per share. So remember, with option contracts, they are usually a contract multiplier of 100. So we would times that by 100. So each contract represents 100 shares. That's how much you control sort of with that contract. So that's going to cost us $1,000 in premium. So what we're risking here is just $1,000 versus, buying 100 shares of Tesla. You'd be risking, or outlaying 15,000 here. We're controlling 100 shares through these options, but we're just risking $1,000. That's the total premium paid. The potential reward theoretically is also unlimited, although it's going to expire in 1 month. But there is a break-even point of 160. So remember, we paid $10 per share, $1,000 for this contract. So Tesla stock needs to get to 160 for our option to sort of break even. So we have the right to buy at 150, but we paid $10 for that right. So the stock needs to be at 160 for this contract to break even. And then lastly, we have our vertical spread. So in this scenario, what we're going to do, it's a vertical spread. So we're going to buy and sell a Tesla call option, and the strike prices will differ. So we're going to buy a call option with a strike price of 150, expiring in 1 month. So we're going to pay out $1,000 for that. So that's going to be a debit, as we talked about earlier in the video. And then we're going to sell a call option with a less favorable strike price of $160, expiring in 1 month. And that's only going to be worth $500. So the reason why is, you've got 30 days and you have the right to buy at 160. It's currently trading at 150. So there's not as much value there. The stock needs to get well above 160 for you to break even on that. So that contract is only worth $500. So that'll be a credit coming in to our account of $500. So that's what we sold it for. That's the premium we received. This is what we paid for the call option with a strike price of 150. So there, our net debit, so to speak, is $500. So our potential risk in this spread, it's much less. It's just the $500, write that out, just the $500 there. So it is not as expensive as just buying a call option, because we gain from actually selling that call option there. And then the potential reward, however, is going to be capped. So basically, anything we earn on the call option we bought, we have that obligation with the call option that we sold, and we'll sort of see the math works out when we run through different scenarios. And then the break even for this particular one would be the lower strike price plus the net debit. So at 155. So at $155, we break even. So we're going to gain, the $500 back for that one. And it only costs us $500 to run this vertical spread. And then the break even for the call option is not as favorable. It's up to 160 and we're risking $1,000. And then obviously with the stock, buying the stock, we had to put up $15,000 there. So right away, just with those different options, you can sort of see the differences there in these three options. So now let's run through three different scenarios. So the first scenario is going to be Tesla stock rises to 165. So it's at 150 and it goes up to 165 in the 30 days. So what's going to happen to the stock purchase? Well, basically you get $15 per share of new profit and you have 100 shares. So, you are up $1,500 with this move, and we invested 15,000 there. So our return on investment is 10% in that scenario. So now with the bought call, the profit is going to be $500 in this scenario. We invested $1,000. That was the premium paid for the call option. So our return on investment is much better at 50% with this $15 move in the stock price. And if we just kind of run through that, again, we have a strike price at the right to buy at 150, and the stock currently is up to 65. So we have $15 per profit per share times 100 shares. So you're up 1,500 on that call option, but we had to actually buy that call option for $1,000. So this is where we would be up $500 on that call option when Tesla moves 150 to 165 within the expiration time. And then for the vertical spread, if Tesla moves $15 up here, our 500 max profit is actually reached, but our initial investment was only $500, so that's a return of investment of 100%. If we kind of look at the math on how that one works, well, we have this call option here, similar to this one, where we are up $500 there, and then we have the option that we sold with some obligation there as well. So if we kind of just work out the math here, we have a $150 strike price and the stock is up to 165. So we are up $1,500 there. And then our initial outlay was a net debit of 500 there. So you can kind of do it like that. And you can say on this side, we're up 1,000, but with the option that we sold, the strike price is 160 and the stock price is at 165. So we are obligated to pay that $500 difference there to that person. And we're up $1,000 on this. So basically we're down 500 there, up $1,000. And this is how we get to the $500 of net profit there. So you can kind of, figure out how you like to do the math. You can either, do the net debit there, or and take it away there, or you can, it depends on where you like to do the math. But basically, this is the call option that we bought. We've profited that, and then basically you could take the $1,000 here and then include the credit that you got there, or you can just take the outlay of the total investment here, and then this is the difference in what you would owe on the sell side there. So that's scenario one. So we can kind of see that return on investment is much better with the vertical spread than the other options when we have a price move here from 150 to 165. So let's look at scenario two now, where the stock doesn't go up as much. It just goes up to up $5. So if it's just up from 150 to 155, if you own the stock, then you've got a $5 profit per share. So you're going to be up $500 there, and then $500 over your initial investment. You've got a return on investment of 3% there when the stock just moves $5. So not bad, but not a huge return on investment. For the bought call, we actually have a loss here. Remember, our break-even point for the bought call was 160. So we have a strike price of 150. The stock has moved to 155, but remember, this call option cost us $10. So we are profiting $5 per share times 100 shares, but the call option cost us $1,000. So we are down $500. So we haven't lost our full investment, but we did lose half of it. So our return on investment is negative 50% there with the call option there. So we didn't quite hit the break-even price of 160 within that month. It only reached 155. So if you have that call option, the right to buy at 150 that you bought for $10, unfortunately, you would be down in that regard. But again, not a huge investment. You just lost half of your premium, which was $500. And then for the vertical spread, the profit is zero here. So there's no gain or no loss relative to that net debit of $500 there. So if for this particular one, we can use this call example here. So for the call that we bought, we would be down 500, but we sold, remember, a call option with a strike price of 160, and that would have expired worthless, and we would have just kept the premium of $500, the one that we sold. So we kept that premium, but we're down on the call option that we bought. So we are at $0 there. So our return on investment is zero in that scenario. Now, lastly, we have a different scenario here where the price of Tesla stock drops quite a bit. So let's look at this where we're moving from $150 and we drop all the way down to $130. Well, if you $20 per share, 100 shares of your investment, you're down $2,000 on your Tesla position if you owned 100 shares. So that's a return of investment of negative 13 and a little bit percent. Obviously, if you don't sell, you won't incur those losses, but on paper, you are down 13%. For the bought call, you're just going to lose the premium, but that is a hard loss, so to speak. So your call option would expire out of the money, and it would expire, so you would lose that premium. So that would be 100% loss there, and then the vertical spread would be down as well. You would lose the 500. Again, that was the max loss. That was the initial outlay that we had for the vertical spread. So again, return on investments is the full 100% you lost, but it's just $500 worth of a loss compared to just the call option where you had to pay a little bit more. And then if you own the stock, you'd be looking at a paper loss of minus 13%. So I think that is a little bit of a example there to show you the differences between the three options there, and then what happens to the stock, and then what happens to your investments when you have a straight up stock purchase, just a call option, or you get a bit more flexibility with that vertical spread. Okay, so just a summary of what we've done on the whiteboard there. These scenarios that we highlighted, they sort of highlight different financial dynamics in any sort of trading strategy. So the straight up stock purchase, it provides a solid but lower percentage gain in a rising market, but it also exposes you to substantial capital requirements. So you need to sort of have that $15,000 to invest in that particular example. And then if the stock goes the other way on you, you actually are incurring significant losses. Obviously not if you don't sell, but just on paper, your profits are down quite a bit. And then with the straight up call option, that offers substantial leverage, a higher percentage gain for a smaller move in the stock. So you have that power of leverage. And that's what options really provide to you. But the risk of total investment loss, if the stock price does not move favorably, is there. So for that option, you are risking that $1,000 premium in that particular example. And then what we saw with the vertical spread, well, this offers really the best risk management, significantly limiting both potential loss and reducing the capital required. So it was half as much as just the straight up call. And obviously, your profits are capped, but your losses are much less. And then if you kind of think about um, the return on investment, how impressive it can be, it sort of demonstrates, how efficient your capital can be used when you set up these types of spreads. And, don't think of a one-off investment where, hey, maybe you'll get lucky and the stock will really jump up and, maybe the other options offer better gains. But if you think of your whole, trading strategy over the course of maybe a year, how many trades you might put on as a day trader, the probability of earning more over the long term with more trades is certainly in the favor of setting up these strategic vertical spreads. And I hope you were able to kind of see that with that example. So I think we'll wrap it up there. Thanks so much for watching. Subscribe to this YouTube channel. Consider watching all the other videos about our option series. What we are doing now, we're sort of moving on to study technical analysis. And again, if you're thinking about becoming a day trader, certainly grab a copy of my 6-month blueprint. It outlines all the steps that I'm taking in the first 6 months of my journey of becoming a full-time day trader. And you can download that absolutely free below this video, or you can go to stokestrades.com/blueprint and grab a copy. So thanks so much for watching. Subscribe to the channel, and I will see you in the next video.